All right, good afternoon. Happy Sunday. Hope you're all doing well. It is time to get ready for the week ahead. So, without further ado, we got plenty of talking points to go over. The theme of the day is that we're looking at two different markets here. One is improving, the other one is degrading and alarmingly degrading. So, we'll see which one is telling the truth in due time. So, without further ado, let's just go ahead and jump into it. The SPY hit an all-time high, or the S&P rather, hit an all-time high of 7,495 on Thursday. Did get a little pullback on Friday. The NASDAQ also hit 25,828. New records, but at the same time, high-yield credit has dropped below 80. The 30-year yield has crossed over 5% for the first time since 2007, and fewer than half of the S&P 500 stocks are in short-term uptrends right now. So we have two markets. One of those says everything is completely fine, up, and away we go, and the other one is saying, no, we're not fine, down we go. So in today's video, I'm going to show you exactly where the possible cracks are, what Berkshire is doing, what we have on to look forward to on Wednesdays with Nvidia's report, and what that means for the entire AI trade. So without further ado, let's jump into the charts here. We got the SPY daily. You can see that we hit a high of 749.53 there on Friday. Everything looks perfectly normal. We have max bull readings. Momentum is still pretty good here. We're pretty far away from the daily 21 EMA, meaning we haven't had a mean reversion since this entire breakout move has occurred. At some point, we will revisit that 21 EMA, whether that's through a pullback or through time, whether we consolidate through time and just bounce around and that 21 moving average catches up. That is yet to be seen, but we did have a little bit of a weaker close on Friday, probably one of the weakest that I've seen in probably about 2 weeks, give or take. But what's really interesting here is if we look at the HYG, which is your junk bond high yield bond ETF. Basically, it's a measurement of, how frothy exactly is this market. And when we look at that, we can see that we did get a breakdown of this 80 level. The 80 level is kind of like my benchmark threshold. Are we above it? Are we below it? Are we trending above it? Are we trending below it? And we kind of got our answer on that on Friday. We started to break down a little bit last week, bumped our head on 80, and on Friday we just had an absolutely nasty day on the HYG. Closed at the lows around 79.46 there. It's not just actively below 80 right now, it's pretty much breaking down. If we look at the TLT, which is your 20-year Treasury bond ETF, we can see that the TLT has completely broken down. This is a very long consolidation period. You can see that 200 was pretty flat for quite some time. We got a little bit of a curl down on that over the past day or two. The 50's pointing down, the 21 EMA is pointing down. We broke down below 85.50 on, what was that, on Tuesday, and we just couldn't get back above it. Thursday there was an attempt, and then Friday, of course, we just sank down, and it's just very yucky here as far as the bond market goes. And we also had the 30-year yield above 5% for the very first time. That's the first time since 2007. So we can already see that we have two markets pretty much running in opposite directions. One of those is wrong, one of those is telling the truth. We'll just have to wait and see which one is actually right or not. But typically speaking, the bond market is usually the one on the correct side of history. Not always, but most of the time. HYG has to do something. Junk bonds, the yields need to go back down. The bond markets need to catch a bid, and we can start see some of that confirmation that we're looking at here for the most part. As far as the macro backdrop here, retail sales were solid, 757.1 billion, which was up 4.9% year over year. Online spending was up 11%. Consumers are still spending, there's no doubt about that. One of the questions that the PCE data is asking is that spending because of higher inflation, or is it genuine? So we've still got some questions on that. As far as Warren Buffett's Berkshire Hathaway, we do have a new CEO, Greg Abel. Interestingly enough, they bought 40 million shares of Alphabet, and he bought $40 million of Delta. Delta is a new position for Berkshire, which is kind of interesting because normally Berkshire doesn't really buy into airlines all that much. I think the last time he bought, or Berkshire Hathaway in general bought airlines, was like during COVID. So that's pretty interesting in itself. The most striking thing though is definitely the buying of Google, and the interesting part is they now hold 54 million shares of Google, which about 15.6 billion. And that's about it though. They're still sitting on a ton of cash, and looking at the overall market right now, the only thing that Berkshire Hathaway felt the need or compelled to buy was Google and maybe a pinky toe in the water of Delta, but that's pretty much it. We did get a sell on Chevron, which was interesting. It's had a huge stake in Chevron for a while. He sold more Bank of America, which he's been in for quite some time. He closed out his entire position of Amazon. He also exited his stakes in both Visa and MasterCard, and Charter Communications, United Healthcare, Domino's Pizza. And all those do represent some significant changes. And Abel has cleaned up a slew of all these positions. It's more weighted. The concentrate is now more weighted in the top 10 holdings with less exposure overall. So in general, just a little interesting. I mean, the only thing they're buying is Google, which is fascinating. Moving on to what he's sitting on $380 billion in cash right now, and he was a net seller by $8 billion at all-time highs. That's pretty crazy. We still have the Iran situation. Talks continue to be stalled. Crude oil here, if we take a look at crude oil, we can see crude oil is still trading at about 101.16 here. It had a bounce from 94. Energy still a major concern, especially for inflation data. It's going to be a tough nut to crack when Kevin Warsh now takes over the Fed. Yeah, crude oil being high, energy is going to be sticky for quite some time. And what the bonds believe are going to be, rates are going to be higher for much longer. So, without further ado, let's continue on. We've already looked at the SPY and the QQQ. All those look pretty much the same as last week. IWM is an interesting story, though, when we look at this. When we look at the chart, it broke back down below 279.88 here, and this could be a potential red flag. Possible failed breakdown. If we get back above that, everything is perfectly fine, but as it sits right now, it's a little bit of a concern. We did close right on top of the 21 EMA. If we start to break down below the 21 EMA, we could possibly see a revisit of 271.60, which as of now, it's not terrible. It's, nothing quite alarming, but there's a possibility that this could be alarming. So there is a difference. So IWM, we want to see that get back to the upside, and we really need to see that with the hourly time frame. The hourly needs to get back above, really, we first get back above 280 and then reclaim some of these hourly key moving averages out there. It's minus 80% here on the overall score reading, and the internal breadth is at 9.6, and that's near maximum bearish on the short term. So small caps for sure under pressure on Friday, no doubt about that. Another key thing that we want to look at is how many stocks are trading above their 50 simple moving average, and this is showing us that only 41% of stocks, 43% of stocks are trading below their 43% of stocks are trading above their 50 simple moving average. There we go, got it right. So as it sits right now, the majority of stocks are actually trading below their 50, which is not a great look. We have index at all-time highs, right? But majority of stocks are in an overall short-term downtrend. And the credit market pretty much explains this, really. You know, HYG, not just below 80, it's actively breaking down. The hourly looks yucky, and there's not a lot of names making new highs, at least. When we look at the LQD, which is your investment grade bonds, this also joined the breakdown this week. Investment grade and high yield, both at maximum bearish readings here for the weekly. That's a bit unusual, and it is meaningful. We do want to see both the LQD and the HYG catch some sort of bids, which means we would need yields to go back down, back below 5%. We need to see small caps, the equal weight, RSP catch a bid. And yeah, I mean, when we look at the RSP, we can see it tried to get into new all-time highs. We briefly tapped it, and then we just rejected off of it. Equal weight, mid caps, yeah, that's not something you want to see. You want to see everything kind of moving in unison for, you know, some form of confirmation. And right now we just don't have that, especially when we look at the bonds. And like I said, TLT is at new multi-month lows across pretty much every time frame. The bond market has been repricing consistently since Wash got confirmed. What was that, Wednesday? And generally, credit leads equities at inflection points. Bond investors are generally more sophisticated and less momentum driven. And like I said, 30-year yields are above 5% for the first time since 2007. And that is a big, you know, signal in my point of view. So what does all that mean? To me, you know, especially when you look at, you know, individual sectors like XLK continues to be at new all-time highs. Semiconductors continue to be strong. We do got a little bit of a pullback on both of those, but it's all concentrated into tech and semiconductors. And we've been mentioning this for a while now, that the longer they continue to push up without any kind of significant pullback or trying to gain some sort of foot ground, you know, when things do pull back on these guys, it can be fast, it can be a little bit painful, and the tape can move very quickly and volatility can spike pretty fast. So that is something that we want to keep an eye on for sure. And if you're intraday trading, you definitely want to be mindful of, you know, how fast is the tape moving. You want to keep an eye on the VIX and the volatility. You can also watch the VVIX, which is the volatility of volatility. That'll give you a pretty big picture of a good picture of how fast things are moving in general. But like I said, you know, things aren't, you know, we're starting to see a little bit of a weak breakdown here. We did get a little bit last week as well on Tuesday, but they shot it back up, of course. So is this just going to be another quick buying opportunity for the market to push higher as we get closer to Nvidia earnings? We'll see. Let's see. Oh yeah, and not to mention mags. You know, this is your Mag 7 ETF. We talked about the weekly inverted momentum last week. Same pattern which preceded gold's 14% correction from 500. It's not necessarily a sell signal. It's just a red flag, warning flag that's popping up, but it is something that we, should pay attention to. Yeah, let me pull that up so you can see what that looks like. You see here on the oscillator on the far right, we can see that the green line is below the red line. That's a momentum inversion. We're at extreme plus. If we look at gold, we have that same inversion when we were at all-time highs right around 500, and we got that collapse. So it is a little bit of a warning flag that could happen. It doesn't have to. This can always correct itself. The green line can flip above the red and so forth. It's just a warning flag. But each week that it stays inverted, the historical probability of that correction continues to increase. So outside of tech and semis, the sector picture gets a little bit messier. So if we look at healthcare names look pretty bad. It's pretty much the most bearish possible daily reading this week. You got a full structural breakdown. You're below all the key moving averages. You got a weekly squeeze that's firing to the downside. You got a fresh new daily squeeze. If that starts to trigger, we could see another push down. Financials here, neutral to neutral down, just sideways, no proper traction. If we look at XLY, which has Amazon and Tesla, not much improvement here either. Hourly looks a little bit degraded here. If we go here, we can see that it's minus 80%, below all the key moving averages. And you got to think too, this is consumer discretionary, so you're also getting hit from two sides here. You got higher rates and a consumer that has a 3.6% savings rate, so it's double whammy. When we look at XLRE, this one took a little bit of a hit. It was looking pretty good, but like I said, I don't really trade XLRE a whole bunch. There's just better things that I like, so I don't focus too much on the XLRE. Utilities, despite, the whole Iran situation, utilities are pulling back. We lost the daily 200 on Friday. You got max bearish readings on the hourly. Rate sensitive sectors go lower as long as 5% holds, and that's going to be the case with XLU and XLY real estate. XLP is probably the most genuine positive reading that we have on the hourly. It's a bull 75%. It's like a classic late cycle defensive rotation signal, so definitely something to keep an eye on as we go into next week. Energy continues to be a bright spot. Like I said, as long as the Strait of Hormuz is closed, and even once it opens back up, it's not going to clear up as quickly as people think or hope. And you're starting to see that in this price action here. So, yeah, not too good. If we take a look at the gold is at $417.29 here, down from $500, 14% correction. If we take a look at the weekly readings here, we can see that weekly squeeze looks like it is trying to fire to the downside. If that's the case, we could see a move back below 400, maybe towards 380. If we look at the dollar did catch a little bit of a bid last week. Test of 100 could possibly be coming this week. And, this has always been a key talking point of mine. If the dollar breaks above 100, that does become a headwind for emerging markets, commodities, multinationals, stocks in general. So we definitely want to be aware of, what the dollar is doing. Last time it tried to get above that 100 level, it pretty much stalled and failed. We'll see if that's the case again this go around. So something to pay attention to this week. But if you are bullish on stocks, you want to see the dollar remain below 100. A clean break above that level pretty much changes the entire commodity and emerging market picture, and everything pretty much funnels into one event, and that is on Nvidia. Nvidia is at all-time highs. Options are pricing in a 7% move either way. So if we get that 2% move, that could be a break of 240. 7% below is 210. Majority of analysts out there are buy rating or bullish in some form of Nvidia, and it's hard to bet against Nvidia, right? They're pretty much the breadth of AI right now. It's up 80% on revenue year over year. And one of the key things that we need to look out for is the Blackwell numbers. The consensus is 34.6 billion, range 9 billion to 67 billion, and that is where, you know, things are a little bit uncertain. We also got the Rubin architecture guidance that we need to pay attention to. We did get some interesting news from the China-Trump deal, you know, with H200 chips. Back in February, they had a blowout quarter. Stock still sold off days later. You know, buy the rumor, sell the news kind of thing. It's up about, what, 57% since June of last year. But the key thing here is that it's not just an Nvidia event, right? It's a referendum on the entire AI CapEx thesis, and you got every hyperscaler has pretty much raised CapEx this year, specifically for AI. So if Nvidia guides cautiously, the AI trade may take a hit, and that will go beyond just one stock. It's not going to affect just Nvidia. It's going to affect pretty much the entire AI trade and downward. So it's definitely something that we have to pay attention to. Like I said, the Blackwell numbers are going to be pretty interesting. So with all that being said, we have markets at all-time highs, bonds struggling to catch a bid and catch their breath, dollars creeping up to 100, junk bonds are deteriorating, IWM broke down below its prior breakout level. We have Nvidia earnings on Wednesday. Kevin Warsh has taken over officially. It's one of those things where the market is bullish, but the amount of risk that's at stake continues to increase out there. So key takeaway is know your levels, trade your levels, and just have that situational awareness and be willing to embrace all the uncertainty. I know it's a lot. Don't give yourself a headache about it. Trade what's in front of you, not what you think is going to happen, because that's how you end up, you know, smacking yourself. So we've had tremendous amounts of bullish energy, especially when you watch the tape. It's been incredible. But yeah, just kind of be aware of what's going on, know what's around you, how things are reacting to news and headlines. Don't try to predict, just trade what's in front of you. That's all I got to say. I hope this was useful. Like I said, I do this every Sunday, and I do my writings on Sunday and Wednesday, and I check to see if the thesis changes. I try not to do any kind of hype. I just look at these charts and tell you what I actually think. I got the full breakdown right up in my Substack. It's free. Every indicator reading, every level that I'm looking at, everything that I track, it's all there. It's in the description. It's free. Like I said, every Sunday with Wednesday. Feel free to leave me a comment. I do appreciate that. Let me know what you think Nvidia is going to do on Wednesday. Are we going to beat and run, or are we going to beat and sell? I'd like to know what you're thinking, at least. I appreciate y'all. Y'all have a great Sunday. Enjoy the rest of your evening, and I'll see you all later. Bye, guys.